on Main Street, because if those disruptions are
Yeah.
larger than expected, the difference between 3 and 6 months is very substantial in economic terms. And while the Fed may backstop it, they still have plenty of ammunition in the tank to continue to tighten investment grade spreads, particularly with the
Hmm.
new facilities that they put in place. They can be buying up to about 2 billion a day in the secondary market to reach that full size by the end of September. Then you throw in the
Right.
primary corporate credit facility, and they have a ton of room that they can work with as well.
Speaking of Fed buying, we have a headline that just crossed, and it crosses every Friday. The Fed slows its pace of Treasury buying to $8 billion a day from $10 billion a day. So we've seen this steady ratcheting down of how much the Fed is buying when it comes to Treasuries. I suppose that's a good sign in that things are stabilizing. Nick, how much of the recent bounce in corporate credit do you think is don't fight the Fed versus something rooted in fundamentals, especially since the Fed hasn't even begun buying, for instance, those fallen angels? Is it 50-50? Is it 90-10?
I'm hesitant to put a percentage on it, Scarlett, but I do think that by dumping a ton of short-term stimulus into the system with the economy shut, the Fed is going to maintain and widen the growth divide that we spoke about earlier between the economic activity and asset prices. Stocks are really only off about 10% from year to date, which in my view, is just a normal correction. Meanwhile, the economy is completely shut. So I think we need to take a step back and say, let's look at the data a little differently, because we can't interpret the typical data that we would see in a normal or a conventional recession. And if this tends to be longer than expected, I think there's a risk of debt deflation growing dramatically, just given the high levels of debt. And that could trigger even more government intervention and even more Federal Reserve involvement in the markets, and, God forbid, the stock market. So the Fed is going to do everything they can, but ultimately it all goes back to us getting back to work, opening up the economy to some degree. And I know there's a ton of debate, both political as well as in the market, that people sort of questioning at what point that needs to happen. Ultimately, we need to sort of increase herd immunity, but also get back to work so that we can get the economy back to maybe not 100%, but something like 80 to 90%.
Yeah. So, Nick, though, when we talk about the corporate debt situation and the potentials for default here, are we running into the issue now where some of the damage is already done, that even once we start this gradual reopening, there are certain companies, certain industries even, that maybe have been hobbled so much over the past couple of months that bouncing back from that is almost going to be impossible?
That's exactly right, Romain. And I think that you're starting to see that. And that's why, like I said, the Fed, they have no choice to pick winners and losers, right? There seems to be fewer losers each day as they include more asset classes. They can't support the entire market. So there's going to be a continued divergence between the parts of the market that the Fed is supporting and the parts that they're not. So that's, as investors, as we look at the market, we say, okay, we're going to avoid certain names and focus on what we believe to be names that are going to be able to withstand maybe another few months of being locked up, or withstand the changes to corporate or consumer behavior, and avoid those names that we think that are going to struggle for not only the next 3 months, but the next 3 to 5 years.
Yeah. Was definitely going to keep an eye on this. Nick, always smart. Great to have you. Nick Marutzis, guys, that's Janice Henderson, Investors co-head of Global Bonds there. All right, coming up a little bit later here on this program, we're going to talk about the food supply chain and the possibility that a lot of us are going to be paying a lot more for meat. Stu Leonard's, it's a grocery chain here in the U.S. Northeast. We're going to talk to Stu himself, Stu Leonard Jr. He's the CEO of that company. That's coming up next. This is Bloomberg.
The COVID-19
All right, welcome back. There's been a lot of talk, of course, about the food supply chain and how grocers and meat producers are dealing with the situation. Right now, we want to bring in the CEO of Stu Leonard's. This is a grocery chain that is concentrated here in the U.S. Northeast, New York, New Jersey, and Connecticut as well. The CEO of that company, Stu Leonard Jr., joining us right now on the phone. Stu, it's great to have you on. Let's start off right now with the supply issues. A lot of folks coming into stores looking for products that aren't necessarily there. On one hand, it's understandable. From your perspective, from your business right now, what is the number one supply issue that you're dealing with?
Well, I think getting the products from the Midwest and from some of the suppliers is the biggest issue we're facing right now. A lot of these plants have been hit with the virus just like the rest of the country has. And production at these plants is down about a third. I've spoke to our ranchers out in Montana, and they have plenty of cattle. He has 35,000 head of cattle. He just can't get them all into the processing plants for them to be processed and then sent to like Stu Leonard's.
Is there a difference in availability when it comes to high-end meat, such as organic grass-fed meat versus the regular stuff?
No, it's pretty much across the board. But if you can buy from a smaller supplier, that's the key right there. Like, for instance, the Tyson plant announced that they were closing. Huge pork plant. We don't buy anything from Tyson. We buy from the local family farms. And one of the nice things, we're able to get stuff at Stu Leonard's because of that. And I would say overall to everybody that, you know what, it's obviously tremendous strain on the supply chain in the U.S. right now, but don't panic. This is a temporary thing. The producers are getting everything under control right now, and people should expect to see a constant flow of meat, chicken, fish on their shelves.
So what about on your end, Stu, with regards to your own employees, the people who are out there stocking the shelves, as well as the cashiers up front who we interact with? How are they holding up? Are you able to remain, I guess, at full capacity with regards to staffing? And are you able to hire additional workers to meet any additional needs you might have?
That's a great question. Right now, we have 3,000 people at Stu Leonard's, and we offer a 30-day sabbatical. It's not paid, but if somebody wants to go visit their families in different countries, we've had over 100 people take advantage of that. These are people that may have medical issues or something. So one thing, even though we're opening America up right now, the challenge I think most businesses are going to find is all of their employees really, some of them don't want to come and work. And you're seeing that with the meat plants out in the Midwest. About 10% of their workforce doesn't want to come to work right now.
So, Stu, can you give us a sense also of how things have shifted from your customers, how much demand has shifted? Are they spending more on meat than other items before COVID-19? Are you providing different products to them in a way that you didn't have to before COVID-19?
Well, what you're seeing is the middle of the plate items are definitely selling bigger, like the steaks and the salmon and the chicken breasts and all of those items. Those are definitely increased, and you also see a lot of baking items going. We've doubled our sales in butter, doubled it in eggs, doubled it in even milk. Flour is we just put a 25-pound bag of flour in the store. We've never done that before. So people are cooking home or pizza dough. I just was talking to our baker this morning, and pizza dough is flying off the shelf. Families are getting together and eating at their homes now.
All right, a 25-pound bag of flour. So I'm going to let my wife know that. She's been scrounging around for flour for a while now. She's been a customer at Stu Leonard's for years, I should point out. When I told her I was going to interview you, Stu, the first thing she asked me, she said she wanted to know whether, well, first of all, she primarily goes there for the free ice cream, but she wanted to know from you, Stu, is the hoedown going to come back this year?
Actually, you know what? We just started opening it. We're going to open it Wednesday, the hoedown, and we just opened it up there. Obviously, we have to practice social distancing. We're very conscious. Everybody at Stu's wears a mask, gloves. We've even spaced everybody out in our own cafeterias here. So we've not only worked on the customer being safe, but also our team members being safe. But the hoedown will be back. I'll get you a big cheeseburger when you come over here.
All right,
All
we're gonna
right.
look forward
we look
to
forward to it. Yeah, Mrs. Bostic definitely looking forward to that one too.
You know, it's a difficult time, but you know what I'm really just saying to our customers right now is don't panic. You know, we have plenty of food on the shelves right now. You can go down and shop and don't panic. And you know what? There's some good deals coming. Like, for instance, our lobster supplier called us from Maine, said the prices are dropping on lobsters. You know, so we got lobster tails. So okay.
We'll be looking for that then. Thank you so much, Stu. Stu Leonard Jr.,
you have
the
a nice
CEO
day.
of Stu Leonard's. You too. Now, coming up, alternative funding during the pandemic. We're going to discuss the fiscal road ahead with the former special master of the 9/11 Victims Compensation Fund, Ken Feinberg. That's coming up. This is Bloomberg.
Adversity.
All right, Apple now providing any kind of forecast for the first time in more than a decade, and that is sparking concern about how the company could fare later on this year. The CEO, Tim Cook, addressed this and the timeline for Apple reopening its stores in an interview with Bloomberg Television's Emily Chang, host of Bloomberg Technology. Take a listen.
Apple reporting revenue that beat analyst estimates, driven by growth in services and wearables. iPhone sales were down about 6.7%, but not down as badly as some feared. I spoke about all of this in an interview with Apple CEO Tim Cook, and the key headline is that he's already starting to see sales resurge. He told me the last part of March and the first part of April were very depressed, and then we've seen a pickup relative to that period of time in the second half of April. We're not projecting what we're going to do this quarter because of the lack of certainty and the lack of visibility. Apple not releasing a forecast for the quarter or the year. Some analysts disappointed about that. But I did get a chance to ask Cook about his pipeline of future products and whether the pandemic will impact some of the products we're expecting from Apple later this year. He said the supply chain remains resilient and durable. He also told me we couldn't be more proud of our current lineup, and we're as excited as ever about the pipeline. We've rapidly built the muscle to run the company from this kind of way. Now, stores have reopened in China, in South Korea, Austria, Australia. He's looking at the first half of May to start reopening stores in the United States, but that will happen slowly, just a few initially. They're also talking about how they bring Apple employees back to headquarters in Cupertino, California. He said there'll be temperature checks, health screenings, and possibly even COVID-19 testing. That's something they're considering, but haven't decided on yet. I'm Emily Chang, Bloomberg in San Francisco.
All right, time now for a quick check of the latest business flash headlines out there right now. Let's take a look at Chevron. The company scaling back capital spending for the second time in 5 weeks. The company also warning that profits are going to suffer as the oil industry spiral, it deepens. CEO Mike Wirth, he's been aggressively cutting spending to conserve cash. The 2020 capital expenditure target trimmed by $2 billion to as low as $14 billion. And Clorox is boosting its full-year sales guidance. The consumer products company, which of course is best known for its bleach, says organic sales will rise 6 to 8% in fiscal 2020. That's a big jump from its earlier forecast of 0 to 2% growth. Sales of cleaning products, of course, have soared during the coronavirus pandemic. And ExxonMobil has posted a quarterly loss. That's the first time that's happened in at least 32 years. The U.S. oil giant reported a $610 million loss, and that could just be a precursor to even starker figures to come. Remember, the earnings period that ended on March 31st, that was 3 weeks before crude prices tumbled into negative territory for the first time in history. And that is your Business Flash update. And Scarlett, there's another story that didn't make it to the Business Flash update, but I'm sure it has to be on your radar. And that's with all of the shutdowns that we've seen in colleges and universities, whether they shut down completely or whether they move classes to online only mode. A lot of students now are suing the universities for refunds, basically saying they're not getting the full college experience that they had expected when they ponied up that $50, $60, $70,000 a year, or their parents did. And, you know, they would think they would like a little bit of that money back, Scarlett.
Yeah, they're seeking class action status, and I suppose it was only a matter of time before someone decided to sue. A lot of the schools have already started to refund room and board, but that's not the lion's share of that $50, $60, $70,000 check that your parents are sending off to the schools every year. That's just a small part of it. And if there's any whiff of classes being online in the fall, I would imagine, Romain, that a lot of parents aren't even going to bother sending their kids to school, because why pay that full sticker price for the possibility of being sent home again or for any kind of remote learning? My question is, I wonder if you can take out insurance on your college investment. I mean, if you're paying more than $250,000 for 4 years of school, it's something worth paying protection for, don't you think?
Yeah, it's something to think about. And, you know, too, the kids point out that, you know, when they pay for that tuition, it's not just for the learning, but it's also the use of the school's facilities. So going online
Yes.
only and not having access
public taxpayer money, the individual eligible victim waives the right to sue. Now, that was the trade-off, whether you could do that in 2009.
The grants to small businesses. We know round one of the aid was delivered through local banks on a first-come, first-served basis. There are all kinds of unintended consequences. It was a rush job. If there's one thing to fix in future rounds, what would it be?
Delivery, just what you guys said at the outset. Operational, streamlined consistency that satisfies our citizens' expectation that what was promised was delivered in a fair, equitable, and bipartisan way. That's the only way that the American people feel that it is a credible program that deserves support.
All right, Ken, really great to get your insights today. We appreciate you taking time to be with us. It's Ken Feinberg. Of course, he is the former special master for the TARP Executive Compensation Committee, as well as that September 11th Victim Compensation Fund and a lot of other crisis responses. Thank you, Ken. Keith. All right, let's turn now to Tesla. We're going to talk about that coming up after the break. Tesla shares down about 9% right now. The stock, is it too high? Well, Elon Musk's Twitter account seems to think so. We're going to talk about that next. This is Bloomberg.
The COVID-19.
All right, time now for our stock of the hour, and it's Tesla, one of the most volatile stocks out there on the day. Right now, down about 9%. This after a series of tweets by Elon Musk caught everyone's attention, maybe for the right reasons, maybe for the wrong reasons. Dave Wilson is here to help us sort all this out. Dave, what's going on?
I'll tell you, Elon Musk was definitely busy on Twitter today. You know, he puts out this tweet saying, "I am selling almost all physical possessions, will own no house." That's the first one. Then the second one, Tesla stock price is too high, IMO, as in my opinion. He didn't go on to elaborate about why it might be too high, but I'll tell you, people responded right away, and, you know, the shares went down as a result of that. And bear in mind, you know, earlier in the week, Tesla had an unexpected quarterly profit that they reported for the first quarter. Is the third time in a row that their earnings beat analyst estimates. We've seen Musk railing against the shutdown orders in California that have affected Tesla's one U.S. assembly plant. So, it's been quite the week for Tesla and for Musk. And so, I mean, you have seen this stock really kind of come back lately from its lows in March. It's more than doubled, at least at one point. And so you can understand why Musk might draw that conclusion.
Elon Musk on Twitter. That's just, everyone has to hold their hats on. I'm surprised that he didn't say IMHO, in my humble opinion, as opposed to in my opinion. Dave, why would traders and investors actually be so quick to agree with Musk when he says the stock price is too high?
Well, there's the recent run up in the shares. I mean, they more than doubled from their low in March. And before that, you go back to their high in February, they more than doubled then too. And you're talking about, a company that at one point was valued at close to $170 billion. So, you've seen much more of a recovery from the lows in Tesla shares than you have, say, for, its Detroit-based peers. Ford, General Motors, they bounced back, but nothing near what we've seen with Tesla. And beyond that, you have to bear in mind, Musk has money at stake, in essence, based on Tesla's market value. I mean, in February, it got above $150 billion. And, if it stayed there, would trigger options for him. It got back there almost this week. And so, when he says the price is too high, it's like he's taking money out of his pocket to some extent.
Yeah. All right, Dave Wilson there with the stock of the hour. Tesla down about 9% at the moment, was down more than 12% a little bit earlier. And of course, one of the big questions here is not just the entertainment value of these tweets, but it's whether at least one of those tweets violated that 2019 SEC agreement that he had to get pre-approval from counsel with regards to any sort of material information about the company. We're going to talk to the former chairman of the SEC, Harvey Pitt. That's coming up a little bit later here on Bloomberg Television. You don't want to miss that. All right, let's get over right now to Mark Crumpton, who's standing by right now with the Bloomberg First Word News. Mark?
Romaine, thank you. Prime Minister Giuseppe Conte is apologizing to Italians, quote, on behalf of the government for delays to their financial aid. He pledged assistance to workers and small businesses is in the pipeline and will be, in his words, stronger, faster, and more direct. He also says parts of the country may be able to open sooner than expected if rules are followed and the contagion curve declines. Australian officials say they'll decide next week whether to ease lockdown restrictions. The rate of new coronavirus infections in the country has been flat. Meanwhile, Australian stocks posted their biggest one-day plunge in 5 weeks. Investors were spooked by gloomy economic data reflecting the impact of the pandemic. Joe Biden's denying a sexual assault allegation made by a former Senate staffer. The presumptive Democratic presidential nominee said in a statement today, quote, "They aren't true. This never happened." Tara Reid says Biden assaulted her while she worked in his office in 1993. This is the first time Biden has publicly commented on the accusation. A government-ordered lockdown didn't curtail the May Day protest spirit in Greece. Demonstrators lined up 6 feet apart in careful rows in Athens' main square. Greek delivery people protested by driving through Athens on motorbikes, and police were out in force to ensure residents didn't head from cities to the countryside, another May Day tradition. President Trump's re-election campaign is set to release a flood of ads highlighting his response to the pandemic. Presidential candidates saturated the airwaves with more than 9,000 hours of political ads this winter. But since most of the country went into lockdown, neither the president nor Joe Biden has broadcast any. Mr. Trump's commercials will begin airing Sunday and are meant to be inspirational, signaling the start of an economic recovery. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Yet another day of risk. Now, the month of May marks Asian Pacific American Heritage Month, and every year, Gold House releases a list of 100 Asian and Asian American leaders to celebrate. In today's Bloomberg Equality, our conversation about the bottom line impact of diversity, we discuss this year's list with Bing Chen. He is chairman and co-founder of Gold House. Bing, it's great to speak with you. And of course, context is everything. And this year, you are honoring these leaders against the backdrop of increasing racism against Asians because coronavirus originated in China. What is the message you want to send to those inside the Asian American community and those beyond with this list?
I think it's a couple of things, Scarlett, and thanks again for having us. First is we want to remind our community and others of how essential the Asian community is to not only America, but the world. I mean, you look at this country alone, we're the fastest growing minority. We're about to be the largest immigrant population. We're incredible spenders and consumers. So we actually have the most rapid spending power growth, about 214% growth in the last 2 decades versus 20% of the rest of our country. And when you look at sort of creating businesses and creating opportunities for others, it's never just about ourselves either. So about 30% of the companies valued at over $500 million from the last decade actually have an Asian founder. And so this is partly about equal treatment and us wanting to have a seat at the table, but it's also to remind people of how essential we've been and how this sort of pandemic doesn't change that.
Yeah, Bing, and some of the names that you have on this list, it's an interesting collection of people. I want to talk about some of the people in the media world, specifically some of the filmmakers and the folks on TV, because a lot of the perceptions about cultures, of course, can be shaped through what we see in entertainment and media. And there's been a pretty large, or at least relatively large versus what it used to be, of films helmed by either Asian actors or Asian directors, and in some cases, producers.
Absolutely. I think something that often people find surprising is on the sort of consumption side, Asians are actually the second highest moviegoers. So it is not a coincidence that there is a market for Asian content or Asian-led content. We also forget that we have the highest rates of internet connectivity. We're the highest media streamers. About 82% of us subscribe to at least one media service. So the market is absolutely there. I think thankfully, media and Hollywood on the supply side, whether it's in studios and networks or publishing houses, have sort of caught up to that demand. And it's been incredibly exciting to see so many of our executives as well as creatives wield that power. I think the other thing that's exciting is you have incredible directors like director John M. Chu of Crazy Rich Asians, producer Nina Yang Bon Jovi, producer Daniel Day Kim, who are not just creating Asian content, but all sorts of multicultural content. So John's In the Heights with Lin-Manuel Miranda is going to, bridge sort of our relationship to the Latino community. Nina has been a beacon for the African diaspora for almost a decade, so forth and so on.
And shout out, of course, to Betty Liu as well, our former colleague here at Bloomberg Television, who's now with the New York Stock Exchange, who was honored as a leader in the business community. Being the third annual A100 list also coincides with the 2020 census. And this is no accident either. Gold House is trying to build awareness, raise awareness, particularly within the Asian American community about the census. Explain to us why it's so critical for Asians in America to be counted accurately. What happens when we're miscounted?
Absolutely. So many people don't know the census is as, if not more important than the presidential election coming this November, because it directly impacts trillions of dollars in federal funding that will impact each of us in our day-to-day lives. The second challenge is many Asians, for a variety of challenges, language barriers, generational issues, candidly fear in some cases, just don't fill it out. And right now, Asians actually have the lowest completion rate of the census, despite being the fastest growing minority population. And again, a disproportionate amount of our economic consumption. That cannot happen. I want to make sure that our people are not only counted so we receive federal funding, but also benefit from the trickle over effects of that funding, whether it's greater societal advancement economically or being more positively perceived in culture.
All right, great stuff, Bing. Encourage everyone to go over to the website and check out that full list of folks on that list. Bing Chen, he's Gold House chairman and co-founder. All right, let's get a quick check of where we stand in the markets right now. Down.
It's 3 p.m. in New York, 8 p.m. in London. I'm Scarlett Fu.
And I'm Romaine Bostic, and this is Bloomberg Markets The Close. And Scarlett, we take a look at the markets right now. We're about an hour left here in the trading day, in the trading week. And of course, we came off of those monster gains that we had in the month of April. The S&P 500 having its best month going back to 1987. The NASDAQ 100 its best month since 2002. But we're pulling back a little bit today. And a lot of the concern here seems to be, how do you reconcile some of the earnings reports that we've gotten that, while not bad, haven't really provided any clear guidance? And then, of course, you have to reconcile with this idea that you have a 4.8% contraction in U.S. GDP in the first quarter, contraction that most people expect to get worse in the second quarter. The VIX starting to gain a little bit. It's been camped out at that 30 level, creeping back a little bit higher on this day, now around 38, 39. As well. When you take a look at the energy stocks, it's interesting too, because they've actually sold off pretty hard today, despite a significant rebound in oil prices on a weekly basis. But of course, when you look at where oil has come down from over the past month or so, it's understandable that you would see a little bit of weakness, particularly with those earnings out of Exxon, as well as other oil companies cutting their dividends, or at least giving some thought to potentially pulling it back. And then Bitcoin there, you can see we were over that $9,000 mark briefly on the day today, as well as yesterday. All right, here to talk a little bit more about what's going on in the market and how you prepare yourself to invest in this environment, we want to bring in Jason Brown. He's Alexis Investment Partners president and founder, joining us right now on the phone. Jason, great to hear from you, even if we can't see you. The last time we spoke, we talked a lot about the potential for a recovery and the potential for investing and being able to take advantage of any recovery once it does begin. As of now, the way you see things, what is the way, the proper way in your mind, to potentially take advantage of the recovery that might be coming?
That's an interesting way to frame things at this point. I mean, obviously, we've had a strong rebound here. I'm not ready to give up on it quite yet. I think the key thing that we have to focus on when we get this kind of massive uncertainty wave, like we have currently, and all the turbulence happening in the market, is you have to just avoid the temptation to think really short term, lengthen your time horizon. I think that's true when it comes to how you're looking at earnings calls, things of this nature. I think also the types of companies that you would select from a stock selection perspective. And then I think just like companies, they're going out right now when I'm listening to earnings calls, and they are making sure that they've strengthened their balance sheet so that they can get through kind of the uncertainty. You have to do that in your individual portfolios as well. So, now that we've had a rebound, we're kind of beyond that initial shock. Obviously, hopefully people didn't sell out at the lows. They're still largely invested.
Mm-hmm.
Yeah, if there are, monies that you're going to need over the next couple of months, I think you do want to raise a little bit of cash there. Maybe that's part of what we're seeing. At the same time, though, for longer term positioning, I think you want to go with those stronger names and recognize that you still need to be invested in order to achieve your long-term goals, and just don't lose sight of where we're going to be 2 years from now, 3 years from now, et cetera.
It's been a pretty incredible run since the lows in late March, which is when we actually last spoke with you, Jason. From what you see, and today being a good example of how Amazon is a pretty resilient company, and it's a clear beneficiary of the lockdown, but even a company like Amazon is going to see a lot of downside from this crisis. Are investors more likely to be surprised to positive news or to negative news going forward?
What I could say about that is when I look at just the overall commentary that I hear left and right, not again from Bloomberg or particular any one analyst, but just across the board, I think people are looking for pullback, surprised by the strength of the recovery. So I don't think that news flow is necessarily what's driving the market. I don't think, again, I would think more people would be surprised, for example, if we come out with a vaccine sometime in the fall, and or if we don't see kind of some ebbs and flows as we try to figure out what the next phase of the new normal looks like. So I think you're gonna expect a lot of negative news. I think everybody's kind of anticipating that. That said, I'm not necessarily also of the camp of thinking that means that a positive surprise is what's going to drive us higher. I think instead, like I said, it would be a very pleasant surprise if that happens. But I think it's more about, thinking a little longer term and just making sure you can survive through this window, and then look at all the opportunities that are ahead of us once we get through this period.
Yeah. So in terms of thinking longer term, Jason, I mean, when you look back at the bull market and how much of those gains were very broad based, this idea that you could sort of invest in a broad based ETF and take part in whatever the market gave you, is that still going to be a sound strategy going forward, or should people be a little bit more selective in slicing up the market into sectors and even individual stocks more so than maybe they did at the end of that bull run?
Yeah, I mean, I think the main thing there is don't try to get greedy, especially in a time like this where there's a lot of uncertainty. So if you're not comfortable, with really doing a lot of homework and picking sectors and so forth, a broad-based index can probably keep you out of trouble. You might consider equally weighted just to eliminate some of the impact that the broader indices like the S&P 500 and Nasdaq have become so concentrated in some of the top names. At the same time, what I would say is beneficial about at least adding some individual selections and maybe overweighting things like healthcare, like technology, and so forth, and avoiding or underweighting areas that are just under more stress. You mentioned energy, I think, earlier. Obviously some of the travel-related stocks and so forth. It's pretty clear right now that those areas are going to probably be under stress for some time. So, it may just give you more confidence to know that the companies you're invested in have a fortress balance sheet, are still growing, are still, receiving positive earnings, so that when you go through periods of turbulence, you're confident to be able to stay the course. But I don't have a major problem using index funds. I just think, again, you want to be really confident in what you own.
Okay, so for those who are more passively inclined, there's still hope there for those who don't have time to do their own homework. What's something that you absolutely want to avoid until all signs are clear and we get more clarity? What's something that you can't afford to be in right now?
Interesting way to put it. For me, it's leverage, right? I just don't see the benefits to owning companies that aren't earning money currently, maybe, and have been relying on the ability to easily access funds and borrow money in order to fund their operations. I just think that those companies just are going to face, higher costs, greater headwinds, and may really run into some problems. I also think, we're going to probably still have social distancing for a little while. So, trying to, respect that makes some sense to me.
Great answer. Jason Brown, president at Alexis Investment Partners. Really appreciate your joining us today. Have a great weekend. All right, let's head over now to Mark Crumpton for our first word news. Mark?
Spain says its death rate from the coronavirus is holding steady. Spain has the second worst outbreak in the world behind the United States. The daily death toll in Spain peaked at 950 on April 2nd. Nearly 25,000 people in Spain have died since the outbreak began. The government is shifting its focus toward reigniting the ailing economy, which is expected to shrink by 9.2% in 2020. Protesters staged a demonstration outside a Soweto hospital today against the lack of personal protective equipment and testing for staff treating coronavirus patients. According to Johns Hopkins University, South Africa has more than 5,600 confirmed virus cases and at least 103 reported deaths. However, the number of infections may be far higher because many people have not been tested. In Japan, the state of emergency that was set to end next week will stay in place for at least another month. Prime Minister Shinzo Abe said today the country's medical systems are still under severe pressure. Japanese health officials have confirmed more than 14,000 coronavirus cases with over 400 deaths. Experts say the actual numbers could be significantly higher. The Canadian government has tapped a veteran of the 2008 financial crisis to deal with the economic fallout from the coronavirus pandemic. Tiff Macklem will succeed Stephen Poloz as head of the Bank of Canada. He'll begin a 7-year term next month. The U.S. Supreme Court's about to go where it has never gone before, and the country will get to listen in live. The court will hear its first ever argument by telephone Monday, opening a 2-week remote session that includes disputes over subpoenas for President Trump's financial records. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Romaine?
All right, thanks, Mark. And just a quick programming note here. You want to tune into Bloomberg Television later tonight at 6 p.m. Eastern Time. That's when we air Wall Street Week. This week, Financial Times editorial board chair
Understand correctly, you only trade options and futures. And so last week when the energy complex was blowing up, we let that simmer over. But now I was just looking into the Bloomberg terminal the last 3 days, oil up 60%. That, of course, after dropping more than 80%, lots of volatility. What are you thinking here?
Right. There's a crazy amount of volatility in the oil market, but in our view, this is probably just the market's way of working out a short-term issue. I mean, we've got obviously some supply issues and some demand destruction going on, but once we get past the June and July contract into the August contract, we're looking for some stability. In fact, we're looking for that contract to hold $20 a barrel.
Well, you sent me a great chart that makes that case. If we go into the Bloomberg terminal, we can take a look at this chart that shows some constructive signs. Talk to us about what you like there technically and why you would buy oil futures on this chart.
So the reason we think oil might head higher is oil is no stranger to 80% declines. We saw it in 2008, we saw it in 2016, and now we're seeing it again. If you just ignore the May contract, which got out of hand, obviously we can all agree with that, and look at the August contract, we actually have had an 80% decline, and we're holding trend line support. It's oversold, it's volatile, that's just the nature of crude oil. But if you take a step back and ignore the May contract, actually it's not that out of the ordinary. In fact, we've seen some pretty miraculous recoveries from chart patterns just like this in the past.
And before we turn to your trade on that August contract, do you think that, does that chart to you suggest that there will be a recovery in demand? Because ultimately, wouldn't that be needed?
Absolutely. So we're looking at, I mean, nobody knows how this coronavirus situation is going to pan out and how long it's going to take the demand to come back. But we're thinking months, not years. And so with that in mind, I do think that it will come back. And with that said, we're getting massive cuts in production and on the U.S. shale oil side as well as from OPEC. So I think that'll come into play as well.
And so the way you would play this through options, we're just taking a look at this now, butterfly call spread. Talk to us about why that's attractive on crude oil futures with all the volatility.
Sure. So I wanted to bring this up because the margins are really high. Most people are being knocked out of crude because they can't afford to trade it anymore, and buying options is really expensive also. So for an educational demonstration here, I'd like to throw this trade out there. It's buying the August crude $30 call, selling 2 of the 35s, and then buying the 40 call. That's a lot to digest, but in a nutshell, what it does is for about $500 to $600 of total risk, you get your foot into the oil market. There's no margin on this trade. The most you could make is roughly $4,500 before considering transaction costs if oil is at $35 a barrel at expiration in about 2.5 months. So this is playing a balance with low risk and no margin.
So you are really managing risks and costs there. I like that chart that you presented also, that RSI does appear to be coming off the bottom, and also the potentially optimistic view that it would give around the economy, that there is going to be some sort of a demand picture returning. Carly Garner of DeCarlyTrading.com. Thank you for once again joining us for Options Insight. Romain, back to you.
All right. Thanks, Abigail, for the Options Insight there. Now, coming up next here on Bloomberg Television, we're going to talk about Chevron and why Chevron is opposing U.S. government bailouts for oil companies that haven't prepared themselves well enough for this historic crash in crude prices. We're going to have that interview with the CEO of Chevron, Mike Wirth. That's coming up next. Stay tuned. This is Bloomberg.
Today's option. It's in our flexible short cycle activity. So that would include unconventionals here in the United States and elsewhere in our portfolio. We've got some other projects where we can slow down activity and focus on critical path and reduce spend on some things that are not on the critical path. So there are reductions across our portfolio, but the primary area would be in the shale and tight, including in the Permian Basin.
So can you give me some visibility then on how quickly you'll reduce rigs and production there, and then what that does to your underlying production base?
Sure. We began the year with 17 rigs running in the Permian. We're down to 5 right now, and so production tends to lag rig activity, and so what we're seeing is production actually reflects wells that came on in the last half of 2019, the first quarter of this year, and as you know, these wells have strong early production. So our production actually is a little disconnected from the rig decline. Production at this point still is on an upward trend. What we've indicated is over the course of this year, we would expect to exit the year at about the level that we entered. So we'll see production higher than that through the middle part of the year, but we'll end the year about flat with how we entered and on a downward slope with this level of activity.
Right, I was going to say, so does that mean that we can expect then lower Permian production in 2021? It seems like that's what you're saying, is you're going to really feel the effects of this CapEx cut?
I think you could expect that. And certainly the other thing that we will be talking to investors about today is the fact that there will be other reductions in production, flowing production. So not just impacts of our capital changes, but certainly in this market, we operate in some countries that are subject to the OPEC agreement, and so there are likely to be some production curtailments there. And then for logistics and economic reasons in other parts of our portfolio, we're also likely to curtail production. So we'll see production here in the month of May down probably 200 to 300,000 barrels of oil equivalent per day, and June, same range or perhaps even a little bit greater than that.
I'm glad you brought up the OPEC plus cuts and the logistics. Do you have a sense of how you're going to allocate your CapEx cuts, like those areas for logistics, those areas for OPEC plus versus your own choice, like say what you're talking about in the Permian?
Certainly our capital reductions are driven by our own views on where the opportunities are. We've got a lot of short cycle capital in our budget. That's one of our advantages. I mentioned we're different. We came into this with the strongest balance sheet in the industry, a very low break even, and a very flexible capital budget. So we're in control of those choices. And the market signal right now isn't calling for more near-term production. So that's why it makes sense to reduce capital in the short cycle part of our portfolio. And we're in control of that. The OPEC actions really affect flowing barrels as opposed to the investment of capital to produce barrels into the future. So and as I said, we'll reduce that primarily in our short cycle activity.
For that production, both for the flowing production and then the short cycle, how quickly can that come back, or is any of that, do you anticipate, permanent?
Well, it can come back relatively quickly. These are things that we actually do for maintenance purposes. We bring wells down and facilities down for storms, hurricanes, things like that. So our people are very good at bringing production down safely and then ramping it back up. So we'll come back up in a matter of weeks when we start to see the market signals that would suggest it. And this can be done in a way that is very careful and doesn't cause damage to wells or reservoirs.
That was Chevron CEO Mike Wirth speaking to Alex Steele earlier today. Let's get you now a check of the business flash headlines, and we begin with economic data because a measure of U.S. factory output shrank in April at the fastest pace since 1948, prompting a sharp reduction in manufacturing employment. This, of course, as the virus tightened its grip on the economy. ISM data showing factory production plummeted more than 20 points to 27.5. The employment index slid to the weakest in almost 71 years. Morgan Stanley surpassing Goldman Sachs to become the top underwriter of U.S. equity offerings as the value of deals fell 10%. Companies raised $41.3 billion via share sales through April versus $46 billion a year ago. That's according to data compiled by Bloomberg League tables. Morgan Stanley climbed one spot from a month earlier, and its market share rose to 11.4% of the total. And that's a look at the latest business flash headlines. And remain, speaking of companies, American Express is the latest premium credit card issuer to change its rewards now that airlines and hotels are no longer part of this brave new world. The American Express Platinum card charges $550 a year in fees. You now get $320 in statement credits for streaming services, and it's also offering meditation apps as well. But to me, it sounds like it's time to change back to those cashback credit cards. Steer clear of these premium credit cards that charge hundreds of dollars in fees.
Yeah, I mean, the whole selling point with those expensive cards was that you had a lot of access to airport lounges and all types of discounts through hotels and other sort of high ticket items. But now, if no one's traveling, then I don't know what you get it for, Scarlett. I mean, if they could apply it to a 25-pound bag of flour, I'd be in.
Well, actually, Chase Sapphire is now giving 5 points or miles for each $1 spent on groceries. So I'm going to be swimming in points after this month, because I haven't been buying 25-pound flour. I've been buying like multiple small bags of flour, but it adds up pretty quickly. All right, let's get you checked up how markets are trading right now. Yes. Although I will have to check that out. That's something Stu Leonard was telling us about.
All right, coming up shortly, we're going to have the CEO of New York's largest healthcare system. It's also the largest employer in the state, Northwell CEO Michael Dowling. That's coming up next.
Yet another day of risk. All right, New York Governor Andrew Cuomo. New York Governor Andrew Cuomo today announced that schools will remain closed for the remainder of the academic year as the state continues to fight the spread of the virus. Michael Dowling is president and CEO of Northwell Health, the largest health system and private employer in New York City. He's an advisor to the governor, helping to guide reopening plans and clinical operations across the state. And Michael joins us now. Michael, great to speak with you. Northwell's hospitals have treated more COVID-19 patients than any others in the U.S. What would you need to see across your facilities to give you confidence to advise Governor Cuomo that the New York metro area is ready to start the reopening process?
Well, a couple of things. One, you've got to see the numbers to continue to decrease, which they are. We have had over a dozen days now in our health system of reduced numbers, even though we have still 1,600 COVID patients in our hospitals today. That is down from a height of 3,500 patients not that long ago. So you want to see the continuous reduction. And you want to make sure that the public continues to practice social distancing. You got to make sure that people wear masks when they're outside. And as businesses open, when that decision is made, that we practice social distancing back in the businesses when they do open. People wear masks, they avoid being in large groups, and that all businesses and the public continue to comply with the prevention side of this business, because if the public doesn't continue to comply, then you could have a reorientation with more cases.
Yeah, and let's talk about that reorientation, Michael, because obviously a big part of the whole reason why we had this lockdown, it wasn't just about the number of people being affected, but it was about the ability of hospitals to treat those people and having the capacity to treat those people. Now that we're starting to see a reduction in growth rates, and hopefully we'll get to the point where we start to see significant declines, are the hospitals right now, are they in a position where they'll be able to manage, even if there is a minor swell up in cases at some point, say a few months from now, are we in a position where the hospitals are going to be able to better manage that inflow if it comes?
Oh, absolutely. I mean, we're in a much better position today than we were when all of this started, even though I will say that the hospitals did a tremendous job here. In our health system alone, we added almost 2,000 new beds. We saw 13,000 COVID patients in our hospitals. And similarly with other hospitals that saw lots of patients, we handled it very, very well. But because of that experience, we know how to create beds quickly. We know how to deploy and mobilize staff into different locations quickly. And we all are putting plans together right now in anticipation that there could be an uptick in cases, maybe in the fall. That's what some people are suggesting. So all of us have put plans together to make sure that we are completely ready if it does occur. So I have no hesitation in saying that the hospitals are ready, will be ready, will have the capacity, will have the staff, and will have the PPE, the masks and the gloves and the gowns, etc. When you go through an experience like this, you make sure that you're ready the next time, and you learn, valuable lessons as you go through this. So the answer to the question is absolutely yes.
I want to ask about your staff, because the doctors and the nurses who are treating patients, they're on the front line here. They're risking their physical health, their mental health. There was an ER doctor over the past week, Dr. Lorna Breen, who was at the New York Presbyterian Allen Hospital, who committed suicide partly because of the stress and the fallout from the coronavirus pandemic and the pain of dealing with all of it. What are you doing to take care of your workforce who may be mentally and emotionally traumatized as a result of COVID-19?
Well, we provide continuous communication to the workforce. I have to say that the dedication and the compassion of the employees that are out there and the courage that they demonstrated was absolutely extraordinary. So we're staying in continuous contact with all of the staff. I personally go out and meet with the staff on an ongoing, regular basis. We're providing a lot of emotional support, mental health support. We have enhanced our employee assistance programs. We provide all of the services that we can provide, and if we need to provide more, we will, to make sure that our staff are taken care of perfectly. It is unfortunate that we've had situations like the one you just mentioned, where somebody took their own life. That's a very unfortunate circumstance. But it is incumbent upon those of us who are the employers to make sure that we put at the center of everything we do the care and the comfort and the security and the physical and mental health of employees. And that's what we're doing. That is a central part of our focus, has been and is now, and will be for a long period of time. My guess is that there will be retention issues as a result of what people went through that will last for quite a while. So this won't end when the COVID-19 issue ends, whenever that might be. So I think there may be long-term effects here, not only for the workers, by the way, but also long-term effects for even the patients who survive COVID-19, who go home. I believe that we will have to provide ongoing, continued support for quite a period of time to come. And that's our obligation. That's what we have to do. And that's what we will do.
Yeah. All right, so Michael, so what is been the effect then on your business, on the bottom line, on the financials here, given that most of your resources are going directly to the COVID-19 fight, and it's going to be months before we get back to any sort of normal sort of hospital operations? Are your financials set up in a way where you can still sort of make this a viable business, or do you need some of that more elective stuff to come back into the mix?
Well, yes, the financial situation obviously has been difficult, but our view is that when you're in a crisis like this and the public depends upon you for their health and well-being protection, you do what you have to do in a circumstance like this. When you're in it, you don't worry too much about the money. We are losing a lot of money in our health system alone. It's in the range of $350 million a month. We're a strong organization. We have a good balance sheet. But obviously, with any organization, you're hoping that this ends at some point, which I believe we're getting to the end of this phase. And then you want to get back your regular business. Remember, when we started, we stopped most of our surgery, even though we did continue to do surgery that was life-threatening. If you didn't do it, somebody would have a disastrous outcome. But most of our revenue-generating business was stopped. And it was stopped for the purpose of being able to deploy staff from those functions into the hospital to take care of COVID patients. But what you do in a crisis, you don't worry about money in a crisis like this. You take care of the public. And then now we begin to figure out, how do we recover? How do we get business back? And how do we get our finances back? And we will succeed. Yeah. We will get back. There is no losing here. You can only win in these circumstances as long as you sustain your effort over a long period of time.
All right. Well said, Michael Dowling. We really appreciate you taking time to be with us today. I know you're busy. We'll let you get back to your work. Michael Dowling, he's the president and CEO of Northwell Health. From New York, this is Bloomberg.
Are parts of your body.
All right, welcome back. Let's speed over right now to the Bloomberg First Word News with Mark Crumpton. Mark?
Thank you. India will extend its nationwide lockdown for at least 2 more weeks, but will ease it in some areas. The number of new infections being reported in India has not fallen despite the 40-day-long lockdown. India had reported just over 600 infections and 10 deaths on March 25th when the strict curbs came into effect. Those numbers now stand at over 35,000 infections and more than 1,000 deaths. That's according to data from Johns Hopkins University. Encouraging signs out of Germany. The number of new coronavirus cases dipped, holding below 2,000 for a 7th straight day. The German government began relaxing some lockdown measures this week, but it will maintain travel restrictions and most other curbs on public life. New York schools and colleges will remain closed for the rest of the academic year. Governor Andrew Cuomo announced the decision during his daily press briefing. Distance learning will continue. A decision on summer school programming will be made by the end of May. Governor Cuomo's edict will impact 4.2 million K-12 college and university students. New York fatalities from the virus now top 18,000. A U.S. House committee launched an inquiry into Carnival's handling of the coronavirus outbreaks. More than 1,500 confirmed cases have been reported aboard its cruise ships, as well as dozens of passenger and crew member deaths. The committee requested the cruise line to begin delivering a wide range of internal documents by May 15th. Carnival's CEO previously said the company made every effort to protect its passengers. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
All right, just want to bring you some quick breaking news here. This on Gilead. President Trump saying that remdesivir drug has been given an emergency use designation by the FDA for as a COVID-19 treatment. Again, this is coming from President Trump saying that that Gilead drug has gotten that emergency use designation from the Food and Drug Administration. Scarlett?
Yeah, and Gilead shares paring some of their losses right now, still off by more than 5%, but getting a little bit of a leg up here. All right, as we approach the close with about 15 minutes to go, let's bring in Joe Weisenthal. And Joe, you always have your eye on economic data. There's quite a lot to choose from today, isn't there?
There is quite a lot to choose from. All of it, pretty predictably dismal. There's an interesting quirk that I think is sort of revelatory about how we think about economics and how we think about measuring economics in the ISM manufacturing report. The headline number was very bad, but it wasn't quite as bad as expected. It came in at 41.5, expected was 36. But the thing that is interesting is it got skewed because delivery times from suppliers to manufacturers were very long. And normally the ISM counts this as a good thing because they interpret long delivery times of being a booming economy. You can't get your goods because so many people want them, so that it takes a while to get them. Of course, we all know that has nothing to do with what's going on right now. Delivery times are slow because of how snarled supply chains are. So you have this incredibly spiked index on delivery times that really sort of masks to some extent how bad every other measure was overall.
Yeah, Joe. And I mean, these distortions, I mean, this has kind of been going on for a while. I mean, even when you go back to the start of the trade war and the fact that some people were sort of buying goods from overseas at a higher clip in order to sort of get ahead of that. When do you think we get back to some sort of normalcy in the data where we can sort of get a much more accurate read of what's going on?
Yeah, that's a really great question, Romaine. I mean, it's so hard to envision, to even imagine what sort of normalcy will look like. There was a really fascinating story on the Bloomberg this week about this sort of like caravan of freight forwarded trucks that have been set up across different continents to move goods that would normally say have moved via sea or something like that. It's fascinating to read about all these businesses that still have to operate in the most trying conditions and still are finding new ways to move their goods. But it's not normal. And ultimately, look, the health of the manufacturers will depend on demand. And demand is going to be a function of restarting the economy and whether the people coming back to work actually, there is
This is the countdown to the close. I'm Romaine Bostic, joined alongside Scarlett Fu. And Scarlett, we're coming off one of the best months for stocks in years, but looks like we're heading right now towards a weekly loss.
Yeah, they used to say sell in May and go away. I don't know if that still applies anymore in this new coronavirus world, but you are looking at a weak start to the month after the S&P closed out its best month since 1987. The Russell 2000 is the big laggard here, off by more than 4%. A lot of people were saying that the market had bottomed overall because small caps finally started to participate in the rally, but we haven't seen that happen in the last 2 days, where small caps have fallen more than the big caps. The dollar ending a 5-day slide, oil closing out its first weekly gain in a month. Remember, OPEC Plus's global production cuts go into effect today. Also, you have U.S. companies from Chevron to Exxon actively cutting production on their end as well. And Clorox, in a sign of the times, is one of the best performers in the S&P 500 after raising its full-year outlook. A huge beat in first quarter. Gross margins also jumped, and analysts say will likely be maintained because of lower costs in the oil sector. So something to keep an eye on there. All right, joining us now for some market analysis is Wells Fargo Investment Institute President Darryl Cronk. Darryl, we've seen this incredible run-up since March 23rd, the S&P 500 gaining as much as 31%, but we've also seen declines in 3 of the last 4 days. So is this a pause in the rebound after a week of some pretty big news from central banks in terms of economic data, or is this start of a new phase?
Yeah, good afternoon, Scarlett. So we actually think there is some risk asset consolidation that needs to happen here. We're at the high end of our fair value range here. You've got a number of elements that are still kind of disappointments to the market. I don't think the market cared for the action that ECB took over in Europe. There's this ongoing geopolitical fault line that's evolving between China and the U.S. We're on the backside. We've now had 80% of the market cap of Q1 earnings report, and so focus will shift to Q2 earnings, which, as we all know, are not going to be terribly pretty. So the market's had a great retracement here, to your point, up 31%. We would expect through a normal bear market that you'd get some retest or moving back down. We're stuck technically in a range between 2750 on the low side, which is the 50-day moving average, and the ceiling at the top is the 200-day moving average of about 3,000 right now.
Yeah, that's a good point. But so, Darryl, I mean, even if we do get some consolidation here as a best case scenario, a lot of investors, they'll say, well, they're looking sort of past the current numbers. They're looking past even Q2 and saying that there will be an economic recovery and that it will be substantial enough to justify some of the valuations that we're seeing in the market right now. Do you think that's the case?
Yeah, it's a good point, Romaine. You know, you want to look out 12, 18 months, particularly if you're an equity buyer, and hopefully, we've got 18 states now trying to reopen and everything else. So that will matter, and hopefully we're back to some semblance of normalcy. You know, we still think 2020 earnings for the S&P are going to come in at $115 a share, you know, which is quite low, not even where consensus are. So we're on the low side of that at this point. And then we've got to see that rebound happen in 2021. I think what's perhaps a little bit underappreciated or misunderstood here too is as we get ready to reopen the economy, the top 3 counties in the U.S. account for 50% of U.S. GDP growth. So, and naturally, those are the most densely populated counties. So the success of opening those counties back up are going to have a large effect on how strong the economic recovery is going to be coming back on the other side.
Yeah, interesting. All right, Darryl, we're going to continue this conversation, but Abigail Doolittle, she's going to jump in here for just a second to update our viewers on what's going on in the market as we head towards the close. Abigail?
Well, there is certainly a bearish tone at this point as we do head into the close on this Friday. Right now, down 2 days in a row, giving back much of the rally that we had on Wednesday. And if you recall, that, of course, was driven by Gilead's virus drug. But as folks start to realize that the efficacy there is reducing the time to recovery as opposed to being a cure or vaccine, perhaps a little bit less thrilled. So what you can see here on the week right now, the S&P 500 headed to a second down week in a row. Sometimes when that happens, that could signal a trend shift, perhaps the test toward the bottom that you all were just talking about. However, when we include small cap and equal weighted, we see that it's a different story on the week. And One thought that I've heard from a few on the street is that the move to small cap has actually been a dash to trash, if you will, and that it's not something that you really want to buy into, more of a momentum or a factor move. And then finally, take a look at that stocks down 3.5%, really pretty brutal at this point as those chips are simply selling off and the near-term uptrend is lower. Now, if we take a look at a year-to-date chart of the S&P 500, you can see to some degree here that the rally trend, I'm not going to call it a bear market rally, although it very well may be, but that rally trend is starting to break. That certainly suggests that we will see some sort of serious test of this year's low as investors start to wonder whether or not the economic data should catch up to the stock market and that the recovery may not be the V shape that so many are hoping for, but something more similar to UWL, or perhaps there won't be a recovery at all. So it'll be interesting to watch that test as it does likely unfold. And then finally, in terms of some of the big movers on the day, Amazon are really a big, there's that 2-day chart of the S&P 500 futures. You can see down sharply, down 4.3% over the last 2 days. The momentum really going to the bears. And some of the big movers on the day, Amazon at the lows had been on pace for its worst day since 2014. This, of course, after they warned that they may not turn a profit in the current quarter. Sales are off the chart, but they're spending on logistics. Investors not giving them the pass, partially probably because this stock was up so much going into the report. Tesla down 10% as Elon Musk sent out a bizarre tweet about saying the stock is too high. Investors not liking that for obvious reasons, and it would be pretty easy to agree with him on a number of metrics. American Airlines, Romain earlier had been talking about how the price target had been cut to $1. Investors clearly not liking that news either. And then finally, the big one this weekend, Scarlett, Berkshire Hathaway, they will be reporting their first quarter. Those results will come out. And of course, that annual shareholder meeting, it's so interesting because Warren Buffett is well known for talking about when it's fearful, that's the time to be greedy. And back in 2008, 2009, Berkshire Hathaway certainly structured a few interesting deals, including one that I remember with Goldman Sachs and warrants. So far, we've not heard of anything, or at least I have not heard of anything of those lines. So I think that folks are going to be looking for some macro commentary there for Warren Buffett and Berkshire Hathaway. Scarlett?
Abigail, great summary there of everything that we should be looking at. Abigail Doolittle with our market check. Now, let's return to our conversation with Daryl Kronk. He is Wells Fargo Investment Institute president. Daryl, I'm glad Abigail brought up Amazon and the earnings that we've gotten from the mega cap tech companies, which have been powering this rebound in stocks. Amazon today is actually the 6th worst performer in the NASDAQ 100 index. What have you learned from the mega cap tech companies' earnings? I mean, for me, it feels like even the obvious beneficiaries of the lockdown are seeing a lot of downside. They can't escape a lot of the pain that we can expect for the rest of the private sector.
I think that's exactly right, Scarlett. Everyone will feel a pain here, an economic pain of the slowdown. If we lose the leadership of technology and infotech and some of those big names, that's a big issue for the indice here. We know the breadth on this retracement rally has been pretty narrow, actually one of the narrowest on record. If you take the bottom 250 names in the S&P 500, they really haven't participated in this retracement rally. It's been very narrow and led by infotech and healthcare. So we need to maintain those leader sectors if we're going to keep moving higher from here. I also think Abigail made a great point about small caps. We don't like small caps here. We think that's a little bit of a trap rally that's happened. You still have almost 40% of the Russell 2000 that still can't turn a profit. They're going to be particularly hard hit by the economic downturn. They don't have the same cash buffer war chest. They rely more heavily on leverage than your large cap indices do. So we would fade any kind of a rally here